Welcome back to the Deep Dive, the place where we turn massive stacks of contractual language and technical research into, well, knowledge you can actually use.
That's the goal.
And today we are diving deep into the financial backbone of global engineering and construction. We're looking at the FIDI Yellow Book.
That's right. Specifically, we are tackling the standard contract for major design and build projects, and we're focusing entirely on, I think, the most critical element, how the money moves.
Clause 14, contract, price, and payment.
Exactly. This is the machinery. It's the meticulous financial system that really determines project cash flow, risk, and, ultimately, its success.
So our mission today is to give you a strategic blueprint. We want to unpack the specific payment procedures, the really strict timing requirements, and the financial safeguards that turn, a handshake agreement and a massive figure.
It's an accepted contract amount.
Right, that amount into a managed, controlled sequence of certified payments. We're going to skip the heavy legal text and really focus on the core strategy and some of the surprising details of how risk is allocated.
And to really understand that flow of money, you have to start at the foundation. So the contract establishes the starting point. The contract price is almost always a lump sum. That's the accepted contract amount.
Okay, a fixed number.
It's fixed, but, and this is a big but, it's always subject to later contractual adjustments like change orders or maybe cost plus calculations for specific variations.
A fixed price makes a lot of sense for the employer. They want budget certainty. But here is, I think, the first great financial risk the contractor has to swallow right up front.
The government.
Who pays the government?
The contractor does. And this is crucial. Unless the specific rules covering changes in laws say otherwise, the contractor is explicitly responsible for all the required taxes, duties, and fees.
And the price doesn't change to cover those?
No. The contract price is not adjusted for these costs. This means the contractor has to bake all of that regulatory risk, including any future changes to taxes, right into their initial lump sum calculation.
Wow, that puts a huge burden of forecasting on the contractor. Speaking of forecasting, what about quantities? If the contract documents have a schedule of estimated quantities, say 5,000 cubic meters of concrete, can the contractor rely on that?
That is a very common pitfall. The rules are crystal clear on this. Any quantities set out in a schedule are merely estimated.
It's an estimate.
Just an estimate. They are not guaranteed to be the actual required quantities for the final works. Remember, this is a design and build contract. That means the contractor is responsible for delivering the functional works no matter what.
So if they need more, they just eat the cost.
They eat the cost unless, and this is the key exception, unless the payment mechanism for that specific item is fundamentally based on quantity measurement.
Ah, so you can build that in.
Exactly. If the parties intend for payment to be based on quantity supplied like, excavation volumes or unit pricing for certain materials, those specific measurement and valuation rules have to be detailed elsewhere, usually in the particular conditions. Otherwise, you stick to the lump sum.
Okay, so the price foundation is set. Now, how do we get the project launched? You can't build a billion-dollar airport without massive liquidity up front. You've got design teams, procurement, mobilization. How does FIDI solve that initial cash crunch?
It uses something called the advance payment system. And provided this is all agreed upon in the contract data, the employer provides an interest-free loan to the contractor.
An interest-free loan?
Yeah, specifically for mobilization and design work. It's really a lifeline. It's designed to grant that immediate liquidity before the first brick is even laid.
But the employer is basically just wiring cash to the contractor with zero physical work completed. That sounds like a massive risk. How do they secure that money?
This is where the advance payment guarantee becomes this critical financial shield. The contractor has to provide this bank guarantee at their own expense to the employer, and it has to be in amounts and currencies equal to the advance payment they received. What's really smart about it is that this guarantee isn't static. Its value progressively reduces, precisely matching the portions of the loan the contractor repays through their certified progress.
So the employer's risk exposure actually shrinks as the project moves forward. That's clever. But what happens if the bank guarantee is set to expire before the loan is fully paid back? That feels like a ticking time bomb for the employer.
It does, and the contract has a built-in contractual hammer to prevent that security from lapsing. So if the advance payment isn't fully repaid 28 days before the guarantee's expiry date, the contractor is legally required to extend it, and they have to show evidence.
And if they don't?
If the employer hasn't received proof of that extension just 7 days before the expiry date, the employer is automatically entitled to claim the entire outstanding balance under the guarantee immediately.
7 days. That is a brutally short deadline. It's designed to force prompt action.
It's a powerful incentive, yeah.
So how does the contractor actually pay this loan back?
The repayment, or the amortization, it doesn't begin immediately. It only starts after the contractor proves they've made sufficient physical progress. Deductions only kick in when the total amount certified in the monthly interim payments exceeds 10% of the relevant portion of the accepted contract amount.
So they have to show they've burned through about 10% of the budget before that clawback mechanism even activates.
Exactly. And once it does activate, the standard repayment rate is a quarter 25% of the amount of each subsequent monthly payment certificate. This mechanism ensures the repayment is directly tied to the cash flow they're generating from physical progress.
And what if something goes catastrophically wrong, say termination, or they hit a major milestone like taking over before the loan is paid off?
The safety mechanism just snaps shut instantly. The entire outstanding advance payment balance becomes immediately due and payable by the contractor to the employer. It doesn't matter if it's because the project's being taken over or the contract's terminated for default, it's just a clean break.
Okay, that sets us up perfectly for the monthly grind, that continuous cycle of measuring work and paying for it. This whole rhythm starts with the contractor's statement.
Right. This is the contractor's application for payment. It's typically submitted monthly. You can think of it as a comprehensive running financial ledger. It's not just a request for cash.
It's more than an invoice.
Much more. It's a detailed assertion of every dollar earned, spent, and owed since day one. It has to list the estimated value of works executed up to that point, adjustments for cost changes, and of course that running tally of advance payment deductions.
What else is critical to that statement?
The really crucial element is the calculation of retention money. They have to deduct the amount specified for retention. That's the money the employer holds back as a guarantee of quality until that pre-agreed retention limit is reached. And the statement has to reconcile all the previous payments they've received. It has to be comprehensive.
Because the engineer uses this document as the basis for certification. Speaking of the engineer, they are the vital intermediary here. Under the rules, the engineer issues the Interim Payment Certificate, the IPC, within 28 days of receiving the contractor's statement. But they can't just certify a single dollar right away, can they? There are hurdles to clear.
2 critical preconditions, yep. They have to be met before any money can be certified or paid. First, the employer must have received the performance security. That's a primary guarantee that the contractor will actually fulfill the works.
Okay, that makes sense.
And second, the contractor must have formally appointed the contractor's representative. So, no security, no authorized manager on site, no cash.
Once those hurdles are cleared, does the engineer have unlimited power to slash or withhold amounts from that monthly certificate?
Absolutely not. Their power to withhold is highly specific and it's limited. They can withhold if the certified amount is below some minimum threshold in the contract data. But more importantly, they can withhold the estimated cost needed to rectify non-compliant work or the value of an obligation the contractor has failed to perform.
So the power to withhold isn't punitive. It's purely correctional. It's risk mitigating.
That's the idea.
But what's the protection for the contractor here? Does the engineer have to explain their math?
Oh, absolutely. That's the procedural safeguard built right into the system. The engineer must provide prompt notice to the contractor, detailing the failure that led to the withholding, the reasons, and the exact calculation of the withheld amount in the supporting particulars.
So they can't just issue a reduced payment. They have to show their work.
They have to show their work, which allows the contractor to either challenge it or, quickly rectify the issue. It brings a level of transparency to what could otherwise be a unilateral abuse of power.
And I appreciate that the system acknowledges human error. If the engineer made a mistake in a previous month's payment, can they fix it later?
Yes, they can. The rules give the engineer the power to make corrections or modifications to any previous payment certificate in a current one. This prevents minor errors from, ballooning into massive disputes. It keeps the cash flow accurate and the overall ledger clean.
Let's shift gears a bit and talk about special payments. For these huge projects, the cost of plant and materials, I'm thinking specialty turbines, massive steel girders that can hit the contractor's budget long before they're ever installed. Can they get paid for those items before they're physically part of the works?
They can, but only if that capability is specifically listed in the contract data. It's a common mechanism, but it comes with some pretty heavy conditions.
Because the risk is higher for the employer.
Exactly.
So what hoops do they have to jump through to prove they deserve payment for something that's still sitting in a warehouse or on a dock?
They need to maintain meticulous records. They have to submit evidence of compliance, things like testing and quality certificates, and provide a detailed statement of the cost of acquiring and shipping the items. And all of this has to be available for the engineer to inspect.
And this is where the employer gets another layer of protection, right? The 80% rule. The engineer doesn't certify the full cost.
Correct. For these materials and plant items, the engineer only certifies 80% of the agreed or determined amount. That 20% holdback, that provides security, and it also ensures the contractor has an incentive to actually move the materials from the storage yard and get them incorporated into the permanent works.
And if those items are paid for while they are literally being shipped across the ocean before they even touch the site, the security requirement is even higher, I imagine.
It is, absolutely. If the payment is triggered upon shipping, the contractor needs a clean bill of lading, proof of freight and insurance payment, and a bank guarantee.
A third guarantee.
A third guarantee, and it's crucial. It has to remain valid until the plant and materials are safely delivered, properly stored on site, and protected against any loss or damage. You are essentially securing assets that are just in transit or waiting to be used.
Okay, let's talk timing. 56 days is the number you often hear cited as the payment deadline. What are the default contractual paces?
Well, the contractual pace really reflects the need for careful verification. The advance payment certificate, that has to be paid within 21 days after the employer receives it. For the standard interim payment certificate, the default payment timeline is 56 days after the engineer receives the contractor's statement and all the supporting documents.
56 days, that's nearly 2 months. It's a long time in business terms, but I guess it reflects the complexity of verifying progress on a major construction site. What if the employer misses that deadline? What's the penalty?
Delayed payment is taken very seriously. The contractor is automatically entitled to financing charges, and they don't even need a formal claim or notice.
It's automatic.
It's automatic. And what's really potent about this rule is that the financing charges are compounded monthly on the unpaid amount for the entire period of delay.
And the default interest rate, I'm guessing it's not a slap on the wrist.
No, it's designed to hurt, financially speaking. The default rate is 3% above the average bank short-term lending rate to prime borrowers for that currency. It ensures the contractor is immediately compensated at a meaningful rate, and it really incentivizes the employer to stick strictly to that 56-day timeline.
Okay, so let's move to the final act of the contract, achieving financial finality. This all starts with the release of the employer's primary leverage, right? The retention money.
Right. Retention money, that amount that's been held back during all the monthly payments, it's released in two phases, and they're tied directly to quality milestones. The first half is released after the issue of the taking over certificate for the works.
So when the project is substantially complete and ready for use.
Precisely.
And the second, crucial half.
That's held until the latest expiry date of the defects notification period, the DNP. This is the warranty period. The employer holds that second half of retention until the contractor has successfully rectified any defects that emerge during the DNP. It's quality assurance until the final moment.
But even when the DNP expires, the engineer can still hold back funds if work remains to be done, can't they?
That's right. The engineer is entitled to withhold the estimated cost of any outstanding work that's required under the defects clauses, even while they're releasing the rest of that second half. It's security until the very last contractual obligation is met.
So once that DNP clock runs out, the performance certificate is issued. That signals the successful completion of the entire project. And that triggers the contractor to submit the final statements.
Right. Within 56 days of receiving that performance certificate, the contractor prepares the draft final statement. This is the complete summary of the entire financial history of the contract. It includes the value of all work, all sums due, and even estimates of amounts related to any pending claims or arbitration that haven't been resolved yet.
And this statement can lead to two outcomes, right? An agreed final statement where everyone's happy, or a partially agreed final statement if there are still disputes hanging over the project.
And what's critical here is that the submission of this financial summary is not delayed by ongoing arbitration. The financial closure process is designed to move forward, regardless of whether every single legal wrinkle has been ironed out.
And that leads to the ultimate legal requirement for final payment, the contractor's discharge. This seems like the moment of truth.
It is. It's the ultimate confirmation. The contractor submits this formal discharge, confirming that the total amount in the final statement represents full and final settlement of all monies due under or in connection with the contract.
When does that discharge actually become effective?
It typically only becomes effective after the contractor has received the full payment certified in the final payment certificate, the FPC, and they've gotten their performance security back. Within 28 days of receiving the final statement in the discharge, the engineer issues that FPC, which states the final balance due after accounting for every single payment, deduction, and sum owed by either side throughout the whole project.
And the final consequence of this whole rigorous process is the cessation of employer's liability.
Correct. The employer's liability generally ends upon final payment and discharge. The only exception is to the extent that the contractor specifically included outstanding disputed amounts in those final statements. If the contractor doesn't challenge the certified amount in the FPC within 56 days of receiving it, they are deemed to have accepted it, and the employer's contractual financial life for that project is effectively over.
You know, this deep dive into the payment rules really demonstrates that FIDIC Clause 14 is not just some accounting manual. It's a high-security banking system for construction, built entirely on these rigorous milestones, detailed documentation, and layers of financial guarantees that protect both the cash flow of the contractor and the assets of the employer.
It really shows that in these mega projects, payment is a formal contractual affirmation of progress and quality, with the engineer acting as this crucial and powerful financial moderator throughout the entire life cycle.
And that brings us to our final thought for you to consider. The entire financial system, it's pushed toward closure by the submission of that contractor's discharge, confirming full settlement. Yet the contract specifically allows that statement of finality to be made subject to ongoing arbitration or unresolved disputes. And that is fascinating.
It really is. The structure is designed to accelerate financial settlement, to get that last major payment out the door, while simultaneously preserving the contractor's right to seek later legal remedy for items they know are disputed. This creates a really interesting tension. How effectively does the system manage to achieve financial finality and cash flow certainty while legally keeping the contract open for complex, long-tail dispute resolution? How do contractors manage that risk, knowing they are signing a discharge but still, in a way, fighting the war? Something to ponder as you look at the fine print of your next major deal.